awesome to have you on the Bainbridge podcast. Thanks for joining.
Thanks for having me.
You have this awesome background of like hardcore finance and then media and brands, and now you're doing venture investing. And I think that's a really interesting background. Certainly has given you a lot of perspective on how to look at companies today.
Yeah.
But it would be super if you could kind of start, how you got into the space, a little bit about your career, how you got to Sugar Capital.
Sure, happy to. So I started my career in investment banking as an analyst in the summer of 2000 at Robertson Stephens in San Francisco. So right when the dot-com bubble was starting to burst, Robertson Stephens was one of the banks that was taking all the internet companies public. It was like, if you wanted to work in tech banking in San Francisco, Robertson Stephens was high on the list. So fortunate enough to get an analyst position there, really had a front row seat to just the whole dot-com bubble bursting. Learned a ton from that, actually, and even some parallels with what's happening today. As I was talking to one of our founders the other day about sort of things that were happening back then that are happening now, and it's kind of interesting. So during that time, yeah, we can talk about that in a bit. But during that time, I met my current partner, Brian Sugar. Went to work for him at a company he started 2002, and that company was an IPTV solution that eventually got sold to AT&T. Once that was all done, went back to banking for a while, joined a few of my former colleagues from Robertson who had started a boutique investment bank. And then a few years later, Brian and his wife, Lisa Sugar, who's another one of our partners here at Sugar Capital, called me, asked me to be a co-founder of PopSugar. This was 2006. So it was right as blogging was about to take off. And Lisa had started PopSugar just as a personal hobby. She was working in advertising and she loved celebrity and fashion and just started blogging about it. It took off organically. And so Brian, who's a serial entrepreneur, was like, we should make a company out of this, called me up to be a co-founder, spent over 15 years running that business. PopSugar is a fairly large women's lifestyle brand, primarily digital media, but we had several commerce extensions throughout the life of PopSugar as well. So we had a clothing brand, a beauty brand. We still have a fitness brand. We did live events. We did all kinds of brand extensions. And at its height, PopSugar was over 500 employees, $100 million in revenue, and had operations all over the globe. So my role there was really about scaling the business from a people, operations, and international perspective. We sold PopSugar to Group 9 Media at the end of 2019. After the integration was done is when we left to form Sugar Capital.
Nice. And, as you're giving the background of PopSugar, I was remembering that era and that was like the tent pole for all these other things that you could go into. I mean, do you think that's a fair description that, sort of the content, the blog, that focus that allowed you to kind of expand? Did you always know you were going to expand into all these other areas, or was it just completely organic? Like
at the beginning, we definitely did not know we were going to. I mean, we still had to figure out the media business model, right? It was so early days back then for digital media that we spent probably the first 5 years growing the audience, productizing the media, growing the sales department. And then we were at a point where we reached over 100 million people every month. And so we started to think about what else could we do with that kind of an audience. And that's really where the commerce piece came in.
Yeah. It's amazing. Also, like, think of the effort that you guys put in to get to 100 million people. And then there's like some person that's just like, oh, I've got that many followers.
Right. Yes. Yeah. I think about that a lot, actually.
So tell me about Sugar Capital. I mean, when you go to the website, it's sugarcap.com. I mean, the first thing that jumps out at you is like, wow, the logos are insane. Like, you guys have done a good job of getting deal flow and making investments.
Thank you.
But tell me a little bit more about what you guys look for, and what stages, and
Yep.
how you think about the world of VC.
Yeah, so we're early stage. So we invest in pre-seed, but primarily seed rounds of companies in the entire commerce ecosystem. So we kind of think of ourselves as sitting in the middle and looking at all of the various aspects of commerce and the brands, obviously, that they're selling to consumers, but then all of the technology platforms, tools, plugin, support systems, all the
Yeah.
things that they need to do what they do. So we invest in that entire ecosystem. We're investing out of Fund 2 right now. We write $1 to $2 million checks. So we lead, but we'll also co-lead, or we don't have to lead. It's really about getting the allocation. So we look to get about 10% equity for a $1 to $2 million investment.
Yep.
We're investing out of Fund 2, which is 75 million. 15% of that will go to brands. So the brands are really important, but it's the lesser part of our focus at this point. And then the other 85% will go to the commerce enabling technology solutions.
And was Fund One set up like that, with that hard distinction of focus?
Fund 1 was same focus in terms of the commerce ecosystem. It was smaller. It was a $25 million fund. Our average check out of there was about $750K. And we ended up with about 40% brands and 60% software. And we set out with that allocation in mind.
Yeah.
And we just, we've learned some things along the way about how hard it is to build a brand and the kind of criteria and metrics that we're looking for. So our bar is a lot higher, I would say, on the brand side
Yeah.
now. But we're really proud of all the brands that we invested in Fund 1. Also, I would say on the deal flow side, coming from PopSugar, we had brands pitching us every day for coverage.
Yeah.
So we had a ton of insight into the ecosystem there,
Yeah.
and a lot of deal flow there, and on the software side as well. But we just looked at so many brands in Fund 1.
Yeah. Well, I would love to kind of get your thoughts on that change in funding, right? Because what you're describing was common across the kind of VC brand ecosystem. A lot of brand VCs that started heavily in brands, more so than even you guys with 40%. Really pulled back. What do you think? What do you think is the sort of common the reasons for that? I mean, there's the conventional wisdom, but I'd love to hear it directly from you.
Yeah. Well, I want to start off by saying we still 100% believe in brands, and we know that there are brands being built today that are going to be the next, household names. So, and we think it's really important, and we think it's important to understand what their pain points are too, so that we know what to look for on the software side. I think it's just a lot harder to build a brand these days, as everybody knows. Customer acquisition online isn't what it used to be. It's a lot more expensive. It's a lot less targeted. You really have to have an omni-channel distribution strategy in place, and even some proven traction there for us to get interested. So I think it's just there are less of those. It has to be category defining or disrupting. They have to be able to speak to their audience in an organic way, have built a community organically, not through just paid advertising, and then have taken that and gone to retail and have some retail contracts in place, some proven traction on sell-through rates there, a path to expand even more into retail. So I think it's harder to meet those criteria, which is why we're putting a lot less allocation there.
When you say omni-channel, does Amazon factor into that, or is that you really looking at D2C or direct to consumer and retail?
Amazon does factor in. We're happy to see Amazon, but we look pretty specifically for like a mass retailer.
Got it. And the organic customer base, why is that so important to you guys? The idea that they kind of have built a community, but not through paid advertising.
Yeah, just because customer acquisition costs are so high. you can no longer build a community by buying it on Facebook and Instagram. You have to be out there creating content. I mean, brands are really content creators now at the end of the day, which we obviously know a lot about from PopSugar. So there
Interesting.
has to be a reason. The content that you're putting out there has to be seen as authentic, not just pushing the product, actually creating conversations, things that people want to share with their friends, actually adding value in some kind of a way versus like, hey, let me tell you like the 3 reasons this product is really great.
Right, right. That makes sense. Do you look at how important are margins in your when you're assessing companies?
Very important. The product margins have to be, high 60%, I would say, in order to go to retail and still maintain cash flow positive margins there. So they're big. So we look at a lot of high margin replenishable things that
Yeah,
people use every day that they're going to keep buying even even in a recession, things that are part of people's everyday lives.
yeah, that makes a
So
ton of
beauty,
sense.
skincare, yeah,
Yeah,
beauty, skincare, food and beverage, sexual wellness, supplements, things like that.
yeah. So you're staying away from like apparel, um, things like that. More, more.
Apparel, one-time purchases, high
Yeah.
ticket items, things like that we're staying away from.
I, I have this hypothesis that brand leaders often, D2C brand leaders often underprice, and so they make life harder for themselves. You know,
Mm-hmm.
I don't know. What do you think about that?
Yeah. Yeah. I mean, I think those days are over.
You
Like you
think
said,
people are like getting religion about increasing prices?
yeah, I do. I think
Okay.
all the founders understand that gross margin is important these days.
Yeah,
So
yeah,
yeah,
nice. What are some commonalities of, when you see brands do well, whether they're in your portfolio or outside? And I know I'm really focused on brands, but a lot of our
yeah,
customers or listeners are brands.
yeah.
So what do you think they do well? Like what common things, what sort of traits do they all seem to have?
It's something that's really approachable, something really mass, something that really could appeal to a really broad demographic, something you could see picture showing up on the aisles at Target and Walmart. So not trying to reach too much of a niche or
Yeah,
being too narrow focused in your even your product assortment. We'll see a lot of really great looking brands that could be mass, but they'll have, like 1 or 2 SKUs, which isn't broad enough to reach
yeah,
a large swath of the population. And then again, they have to have a very authentic content strategy. So many of these brands are hiring ex editorial people from magazines or from PopSugar or other places that are used to creating content about beauty or what have you. So a really strong content strategy, and then a really strong idea of where to put that content and which kind of content does well where. Uh,
yeah,
and the other thing that we're seeing that we really look for with the brands is you have to have the duo, the ideally co-founders, one that is the brand vision, the product vision, the content vision, understands the audience that they're trying to reach and how to reach them. And then the other side is the operator, somebody
hmm,
who understands supply chain and inventory and how to get into retail and how to price items and actually run the business. That combo, we have a lot of those combos in our current portfolio. And we've just learned over the past few years that it's so important. So if it's not a co-founder, at least it's a right hand person, or somebody has one piece of it and they know they need the other, and it's going to be one of their first hires after they raise money.
that's really interesting. It makes so much sense when you say it, and it sounds so obvious, but I'm like, I've never thought of it that way before.
Yeah.
Do you think I could see if you had the founder, a single founder, let's say that you didn't have the duo, so you're a founder, and you're like, okay, well, I've got this vision part nailed. Like that's my specialty, right?
Mhm.
I don't have the ops part. I could see you could hire into that. You could be like, okay, I go find a really good. Even if you're 3 years in, you could just hire somebody and you'd pay the money and the equity to do it.
Yeah.
If you're the ops person as a founder, can you hire vision, or are you just like,
No,
oh, you're screwed?
no, I was going to clarify that. You have to have the vision. Ideally, you have the ops. But if
Yeah,
you have the ops and not the vision, it's just it's not going to be what we look for, which is just a really authentic brand.
yeah, right. And is the reason that you need mass retail because otherwise it's hard to build like sort of the revenue base to get to a really big exit?
Yeah.
Okay,
Yeah. You just can't build that online anymore. Customer acquisition is just too high. You just can't. And also, so many of the brands that we look at are products that are more impulse, right? Like if I need face cleanser, I need to go to Target today and get it. I don't want to wait 3 days for it to come online. So we
right.
really think about the online piece is where you build the brand and where you build the community and where you show up all over the internet. But the
Yeah,
majority of the revenue is going to come from retail distribution.
yeah. And that the reason you start is a reason that you start with sort of the D2C first is so that you have provable data points for those buyers at Target and Walmart, or can you start the other way? I guess can you start in
I,
retail? Yeah,
You can absolutely start the other way. I mean, so many of these retailers have accelerator programs that a few of our brands have been a part of. Like Target has one, Sephora has one. I'm sure others do as well.
mhm.
I don't really think I think a lot of brands just start online because it's easier. You just start, right? You throw up your product, you throw up your branding, you start to understand your customer, you start to reach your customer, and then that attracts the retailers. But I don't think there's any reason why you can't do it the other way around.
Yeah. How does that? Do you guys have experience in helping brands sort of make it into the mass retailers, or have they already done that by the time they reach you?
Most of them have already done it.
Okay,
Yeah.
because that I think is a
Or they're at least in conversations, like they've already reached the right people.
yeah. It's so different, right? You hear these stories from founders and they're like, oh, well, there's like two buying cycles a year, and
Yeah.
we didn't make it this time, but maybe next year,
Yep. Yeah.
like an
We hear that
instant.
a lot. We hear that a lot. And a lot of times, we say, come back in 6 months. We think
Yeah.
this is the potential, but we really need to see that proof.
Well, any tricks that or tips that you guys have picked up that help founders get through those conversations and have success? Not just get sort of deferred for another 6 months.
Yeah. I think it goes back to having a brand that shows up well on shelves, that people will pick up when they're doing their target run, that has some momentum already out there and some buzz about it. It also has to be a category that the buyer is looking for. So you have to make sure you find the right buyer in the right retailer in
I
terms of
see.
and trying to understand what kind of assortment they're trying to get out there and the kinds of new things that they're trying to buy into.
Can a
I would
found?
say,
Oh,
and
sorry.
then what's that?
Keep going. I
Yeah.
interrupted you.
And then you also have to be able to, once you get the PO, you have to be able to buy the inventory. You have to be able to make sure that you've got the ops in place to get it into your warehouse, to then get it into their warehouse
Yeah.
on time. I think a lot of the retailers look for that as well. It's like, do you have actually the right back end in place to fulfill these orders?
Yeah. Yeah. Because there's, it feels like sometimes the focus is so much on getting the PO. And then there's like
Yeah.
this, like, oh, damn moment. Like, now what do we do? Like, they're
Yeah.
asking for like 2 million of inventory. Like, we don't have that. Like, how do we get
Yeah.
it?
And it's tough. We actually do meet a lot of companies who are at that stage. They have the signed PO, but now they're raising because they have to buy the inventory. And
Yeah.
that's a phase where we will get involved if we really gain conviction around the brand and the product and can see the signed PO, then we will certainly invest at that stage.
Wow. So you guys can move really quickly then, it sounds like.
We're a small team. There's only four of us, and
Yeah.
we yeah. we're pretty nimble.
Yeah. I had an experience like a couple weeks ago in Target. I had to buy deodorant. So I'd like, of course, everybody knows the native story. And you're like,
Yeah.
but it's like sort of theoretical, right? Then you see it on the shelves and you're like, oh, now I get it. Like they're selling deodorant for $13 and like Old Spice is $4. Like no wonder Target loved this thing.
Right. Yeah.
It's like, but it really made, just like what you said about it has to be like searchable on the shelf. They have to want it. You have no choice, but you're sort of scanning these shelves, and there's like a whole row of native deodorant and all these like cool kind of colors, and looks totally different than what you've seen. It's surprising that like how powerful that is. I guess that's what kind of like shocked me is like it doesn't seem like it wasn't like some whole new technology. I guess there is technology. I don't know.
Yeah.
It
Yeah, no,
wasn't. It
that's
was,
exactly right. And one of the things I think about too is it can all look good on paper, the signed PO and the number of SKUs and all of that. But if you can, it's also really important to actually visit the store and see where on shelf is it? What kind of position does it have? How many other competitors are also on that shelf? Those are important pieces that are hard to get through just, conversations and meetings. You really have to do the actual.
You guys actually do that? You'll go
Yeah.
out and shop the stores? Oh, interesting.
Yeah. Yeah,
And
absolutely.
how do you as a brand, can you control that? Or is it just like, as Target, just like, I'm putting it where I feel like,
They don't have a lot of control over it. Target
yeah,
really decides, and I do think it's a negotiation at times about, shelf space. Do you get an end cap? Do you not? Who does it appear next to? But if you're just getting into Target, you don't have a lot of leverage. It's
yeah,
really then about getting in and the sell-through numbers and then having a little bit more leverage after that.
yeah. So we talked a little bit about like the things that successful brands seem to have in common. What are some mistake? What are things that unsuccessful brands have in common, or common mistakes?
Yeah. I think I touched on it a little bit. Being too narrow in either your target customer or just not having enough of SKUs to really make an impact on the shelf, really
Yeah,
stand out. Undercharging, like you said, not having the margins there, not having the ops in place to fulfill orders. Even so many brands are even sold out D2C, which
yeah,
has obviously been a problem over the past 2 years with all the supply chain issues, but really dialing in on that. And then, spending too much on paid marketing, not having the customer acquisition costs align with the revenue.
yeah.
Huge. Those are probably some of the main pitfalls.
Running these brands, I think, is a real challenge. And it's interesting to hear you say that there's often a pair there, because that makes a lot of sense.
Yeah.
If we focus just on the operations person, what has always struck me about these brands is like you've got to master like often international supply chains or some form of like manufacturing process, raw materials and assembly and whatnot. You've got to master logistics,
Yep.
and you are now having to master logistics across like 2 or maybe 3 different types of businesses. Like, I've got my D2C business, I've got some Amazon, and I've got to deal with them.
Yep.
And now I've got retail, and that's a whole different kind of logistics and buying cycle.
Mm-hmm.
Product development, I've got to do marketing, I've got to do paid acquisition, finance, operations. It's like kind of staggering how complex these businesses are.
Mm-hmm.
So given all that, like what do you think good operators look like in this space? Like when you think of some of your companies that have had some really exceptional operators, like do they come from a certain background? Are they athletes? Are they specialists? Like what is it?
Yeah. A lot of them came out of like Unilever or P&G, and they actually managed a business within one of those. That's a great background. A lot of them came out of retail, so they understand what it takes to get a product on shelves. those I would say are probably the two most common backgrounds. Or they ran a D2C business before and now they really understand all the pitfalls
Right.
and have a lot of
Yeah.
learnings.
Wow. That's because that's like, I'm actually frankly surprised that you said, a Unilever or a retail makes total sense. You're like, that's not been like the sort of, oh, the ops person coming through a D2C brand in the past. It was like,
Yeah.
you know, you weren't, I wasn't seeing them coming out of like Unilever, but it's interesting because like, yeah, they understand how it should work.
Yeah.
And then they can kind of go into these brands and like, okay, this thing's a total mess. Like,
Right.
let's start straightening it out.
Yeah.
And I wonder if that's it. Do you think it's because they understand like how it needs to work and should work, so they can sort of fix the behind the curtain,
Yeah,
clown
exactly.
show that is often going on. I mean, I'm
Yeah.
not banging on every small company has that issue.
Yeah. Yeah, I think exactly. Like they've sort of had the MBA in in inventory and supply chain and getting product on shelves and they understand. I mean, so many of those big companies have training programs where they put people through that type of a program. So those are, I think, in my mind, ideal candidates.
Interesting. Oh, that's awesome. Yeah, and if you are the founders that you're running into, are they like, do they know that they're going omni-channel like from day one, or are they, like, oh,
Lately, yes. Lately,
yeah,
they understand that for sure. Almost every pitch deck I see, even if they don't have any sort of traction yet, 2 years out, it's like Target, Walmart, Sephora, what have you.
right,
They know.
right. Um, Switching off of brands, like what you guys get this like phenomenal flow of information. So you'd said something earlier, like, oh, this is sort of similar to like the .com bust that you had sort of had the fortune to kind of live through and
Yeah.
observe firsthand. How is it like that? Or maybe I misheard you. Is it not like that at
Yeah.
all?
Yeah. Well, no, I was more referring to the fact that so many companies who were trying to do the same thing 20 plus years ago are now doing it successfully. So what I was talking about was I was talking to a founder and we were talking about pets.com and Webvan, and there was a on-demand delivery service in San Francisco called Cosmo, all back in
Oh,
the summer of 2000. Every single one of those companies failed. But now we have Chewy and we have Instacart and we have GoPuff. So some of those businesses were just too early for their time. Not enough people were online, there wasn't enough broadband, people weren't used to putting in their credit card on a website, there were no phones, right?
right,
So you couldn't just pull out your phone and order your groceries. So
right,
I was more referring to the companies that might be failing now might just be too early for their time.
right,
We might just
right.
need a little bit more adoption in certain
Yeah,
areas.
which is sort of like a lesson for some college student who's can observe this 10 years from now. Be like, now's the time, right?
Yeah, yeah, exactly.
If you're one of those founders now, you're like,
Yeah. I went
don't
to
think I'm
school in Seattle at the University of Washington, which was a booming, a burgeoning, I guess, tech hub back then,
yeah,
even. And some of the companies I met were like really like the streaming services now, but just nobody had broadband. I mean, I think back to one of those companies that everyone was trying to get an internship up at that ended up failing. And yeah, it's just sometimes you have to wait for the technology to catch up with the ideas.
yeah, yeah. On that front, what are you seeing in the commerce enablement space? Sort of the 85% of your target.
Yeah.
Like, what are some of the trends or things that you guys are observing?
Tons of companies trying to solve customer acquisition,
Hmm.
then conversion, right? So it's so expensive to get a customer to your site, but then only 3% of those visitors actually convert into sales. So a lot of
Mm-hmm.
companies trying to solve that piece about how do you actually convert those customers. So we're seeing a lot in personalization, a lot in discounting, dynamic pricing,
Hmm.
um, a company we invested in is a company that monitors your site for errors. So somebody was trying to add something to cart, but they couldn't, or
Mm.
they had to make a choice that they didn't want to make, so they never got to the checkout. Um, Companies that are also, focus on the checkout page, cart abandonment, ways to decrease that. So
Yeah.
that's a big theme, I would say. Um,
Yeah.
and then still companies coming up with influencer solutions as
Mm.
companies are understanding that that is a way to reach customers.
Yep.
So we're seeing a lot there. We're also seeing a lot, it's sort of interesting, it's kind of this third phase of commerce on the internet. So the first phase was all the retailers going online. So
Yeah.
jcrew.com, gap.com, all of that. Then came the phase of these direct to consumer brands. So they didn't have a storefront, but they all started online and they were able to take advantage of acquiring customers cheaply through online ads. And now that's all coming to an end in terms of it being inexpensive to acquire customers. So the third wave seems to be about like, okay, who else can we get online that's not online yet? So we're seeing a lot of companies who are targeting contractors, tradespeople,
Huh.
even like small mom and pop businesses that are selling, you know, bone broth out of their house. So trying to
Right.
get kind of that last long tail of people online and using the internet and e-commerce in an efficient way
Yeah.
is something we're seeing a lot
Yeah.
of too.
That's interesting. Yeah, because yeah, you just sort of naturally like you're like, oh, I need a plumber, and so then you start like you're like, wow, this is surprisingly hard to find people online,
Yeah.
right? Like I don't know who to trust. I don't know
Or
if I
maybe
really.
they have a static web page or they have a Yelp page or something, but there's nobody
Yeah.
to book them. Nobody likes to make phone calls. I hate making phone calls. I would rather just book my plumber online in between
Right.
meetings.
Yeah. Yeah. That's
Mhm.
interesting. You. Oh, what are you seeing in terms of like you were saying customer acquisition, and I was like thinking you were going into like paid acquisition. So like, what are you seeing in terms of paid acquisition? Like, it's like how's that market changed?
We're invested in a company called Disco, which is really tackling that problem. Their initial idea was how can we create these cohorts of like brands that will
Hmm.
then advertise, be part of a network where they show up on each other's sites. So
Mm.
Jisco's initial product was pretty simple. Like I buy some olive oil, say, on Brightland, and then underneath the confirmation page is like other brands that might go well with your olive oil. So maybe
Right.
there's, a spice packet brand, or maybe there's Caraway, for example, pots and pans, things like
Yep.
that. So that one I would say is probably the biggest bet we've made on the customer acquisition front. And they're doing really well, and they're growing their network, and they have email products now as well, and they have
Nice.
products right on the product description page and things like that. Um, then more on the sort of influencer, but also customer acquisition side is a lot of companies around like how do you turn your customers into evangelists or ambassadors or
That's interesting.
influencers for your brand,
Yeah.
and easy, simple ways to do that. So we're invested in a company called Bounty that on the confirmation page you can have the ability to become an influencer. So you can if you create a review on TikTok, then you can sign up to have it be connected to the brand, and then the brand pays on a CPM basis for page views.
Wow.
Yeah, so it's super seamless.
Automatically.
Yeah, you have to. I mean, you have to as a customer, you have to engage with the product, and then you have to create an account, and then there's guidelines about the content. But yeah,
Yeah.
anybody can make a video about TikTok or take a video
Right.
on TikTok about a brand, and if it catches momentum and actually gets views, then you'll get paid.
Yeah. I mean, that sounds like it like dramatically simplified the kind of affiliate marketing flow, and I gotta like choose my platform and then
Yeah,
on and on and on and have some agreement or something. I don't know. It's like,
yeah. We had
that's
a
cool.
we had an influencer business within PopSugar where we would match brands to primarily bloggers back then. and we sat in the
Yeah.
middle and we would negotiate between the brand and the blogger, and the brand would have all these crazy restrictions about what they wanted, and then the
Hmm.
blogger, if they were big enough, they would have managers that would get involved and negotiate these long, complicated contracts. And so we that really resonated with us because
Yeah.
we were like, wow, if you're going to
It's
make
like,
that process so much simpler, that makes a lot of sense.
right, right. You could see somebody just like, well, if it's this easy, maybe I'll just give it a try, and then,
Yeah,
oh, I'm not bad
yeah,
at this.
yeah.
Interesting. That's cool. What about what's sort of your take on paid acquisition? Like, what do you? What's the kind of word? I know that you guys aren't probably investing in that space, but
Yeah. No, we're really not. We actually look, one of the things we look for brands, actually, that I didn't say before, is that less than 20% of revenue goes to paid acquisition. So again, yeah, we're really not looking there at all.
yeah, that's how did you choose 20? I mean, it sounds like a good number, but was there?
Yeah, just how it works out from a margin perspective.
Yeah,
Bottom line is like,
yeah,
even if your gross margins are good, your product margins are good, but then you're
yeah,
spending 75% of that margin on paid marketing, there's no
yeah.
way you're ever going to get cash flow positive at the end of the day.
Right. Do you have a number for all marketing? Like, is it 25% or
Yeah,
30%?
I would say 30-ish.
Yeah,
As a lot of the times when the brands are getting into retailers, they do have to spend a lot of money actually marketing the fact that
yeah,
they're in retail. So we give them
right.
a little bit of a pass there. But at
Yeah,
scale, 30% is a good number.
yeah. What speaking of these metrics, like, what do you think of there's like the marketing efficiency or MERS or whatever, MERS,
Mhm.
right? Where people are like trying to benchmark, like, oh, I'm going to spend, a set percentage of revenue
Yep.
on marketing or advertising. Um, and it's always kind of not, hasn't. I'd be interested in hearing your thoughts, but like my issue with it is like, why would you lock in your margin structure? Like, shouldn't the goal of your marketing spend to be, you know, getting leverage out of it so you don't have to keep spending 20%?
Right.
Um, I don't know.
Yeah.
What do you?
Yeah,
I know
sure.
that's kind of
Yeah. At scale, it should be even less.
yeah.
Yeah.
That's like because then you get into all these like yeah. So it's like I've always found it as a benchmark like really difficult to like find useful because like oh well, what stage are you?
Hmm.
Oh, what's kind of sub segment are you? What do you
Yep.
do? Then you
Yep.
have like sort of this like spreadsheet that ends up having like oh well if you're this stage it should be 25%, but if you're this stage it's 15. You're like well it's kind of useless. How do I benchmark against any of
Yeah.
that? But I like that you're like holding the line and like you're like look at 20 it's like come on you got to do something else. That's
Right.
interesting.
Yeah.
Yeah.
Exactly.
Oh boy, you like. I'm now curious to go back and find out where everybody is.
Yeah. Yeah. Do that and let me know if you find some good ones.
Yeah. Um, what and where do you like the big topic or a big topic today is like kind of like there's this like the sky's falling. It feels like I mean everybody's
Yep.
who knows what's going to happen and the Bay Area is going to for people listening. This is like November 16th of 22. So you know, Twitter firing half the staff.
Hmm.
Meta announced 11,000 people. Just
Yep.
like seems endless. Like, what do you think is coming in 23 and 24? And what are
Yeah.
you guys talking to your portfolio companies
I don't think anyone knows exactly what's coming, but we're telling everyone to prepare for the worst. Would be our across the board advice. So,
about? Wow.
if you eh, don't try to triple revenue in 2023. Try to grow nicely, but set a plan that you can get to with your current headcount. Like, don't go on a
Yeah.
huge hiring blitz to get to tripling your revenue. Just, I think the saying in the industry right now is default alive, right? So set a plan for the next 24 months with super realistic goals that you can get to with current headcount or possibly less.
Yeah. And do you, in your personal opinion, is this like as bad as it's ever been, or what do you, how does this rank in terms of cycles?
I've been through the first dot-com bust. I've been through the 2008 recession while we were operating PopSugar. All I would say they all felt long at the time, right? They were all say 2 or 3 years before anything really bounced back. Um, I think it's going to be the same thing. It's going to feel really long. So heads down, buckle up. It could
Yeah,
last a year. It could last 4 years.
yeah,
It's hard
yeah.
to know.
Any good news on the horizon? I hate to end here.
Yes. Um, yes, I think the good news is these are the times when the best companies are created.
Yeah,
These are the times when operators, investors, everyone really has to buckle in and heads down, and every single dollar spent matters. And so, operators that can operate companies successfully throughout these next few years are going to be the next success stories of
yeah,
the next cycle.
yeah.
You know,
Actually, I do have one more thing to ask you because it's what's been so interesting is like your take on this space is really unique and well, it seems informed by a lot of looks at it and from different ways. So at Sugar Capital, you get Krista, but like what other, things make Sugar Capital stand out as an investor as compared to, where other people could go?
yeah, I think that we were operators for way longer than we've been investors. So I think that really resonates with founders.
Mm-hmm.
There's four of us, and we each have our own areas of expertise. So my
Mm-hmm.
area of expertise is much more on the growing teams, planning out orgs, scaling the business from an operations perspective. Then we have Lisa, Lisa Sugar. She was the voice and the vision and really the brand of PopSugar. She led PopSugar through all the various evolutions in content. When we started PopSugar, there was Facebook, but you had to have a .edu email address
Mm-hmm.
on it.
Yeah.
There was no Instagram. There was no TikTok. Not really even Twitter to the extent that Twitter is out
Yeah.
there today. So, her value add to founders is brand building, content creation. How do you maintain your brand and your voice across various platforms? And also just she just kind of knows what people want and and how to create a brand that people resonate with. And then there's Will Hawthorne, our fourth partner. He he was a banker. He was our banker actually that advised us on our sale of PopSugar to Group 9
Nice.
Media. So he's really good at working with founders on financing strategies, how to get to the next raise, metric, uh, key areas that you need to hit on, key proof points. He's really good at M&A advisory as his background. So when companies get to that stage, thinking through how that process could work, and then all of the, of course, back end financial diligence that needs to happen, he really takes the lead there. Um, and then Brian Sugar was the CEO of PopSugar. He's been a serial entrepreneur. He started several businesses before PopSugar. So he's really a founder mentor, like really working closely with the CEO,
Nice.
giving advice, being just someone to listen and kind of navigating their way through the startup journey. He's a software engineer, so he's a big product guy. He can talk through that, go to market, with market fit, all of that kind of stuff. And he also has a pretty decent following on Twitter, and he's been in the investing world for a while. So a lot of the deal flow
Nice.
comes through him, as well as Lisa.
Yeah. Well, that's a super powerful team and offering. How do you guys like? How do you get your intros? Do you like them warm? How do people get in contact with you?
Yeah,
What's the best way for a
we
founder?
have a contact form on our website that
Do
We
you
really
recommend doing that though?
it's probably the hardest way to get
Okay.
in. We do have a bit of a backlog there, but we do check those emails.
Yeah.
I just didn't want to say we don't take cold outreach because we
Okay.
absolutely do. A warm intro will probably get you there more quickly. Um,
Yeah.
we actually Brian actually gets a lot of intros from Twitter, like people that
Like DMs.
yeah, DMs. Um,
Nice.
and then our founders are a huge resource or a huge source of deal flow. Anytime a lead comes in from a founder, we definitely take a look at that immediately. That's a
All right. Well, that's the playbook then. Everybody,
yeah.
fair warning. Everybody knows how to do it now.
Find a founder in our portfolio, make friends with them, and have them introduce you. That's probably the best.
Nice.
Well, and then also later stage VCs too
Oh yeah.
that are
Yeah.
too early for them. We get a lot from that as well.
Yeah. Nice. Krista, this has been awesome. I really enjoyed it. Thank you so much for joining.
Thank you for having me. Happy Thanksgiving.
Happy Thanksgiving.